Hello traders, this is Chris Buss with Traders Profit Compass with your Weekend Profit Navigator for the week of July 26th. For those of you that are new to the channel, over the weekend I like to take a broader view of markets as opposed to our daily note, which focuses on short-term time frames and active trading for the day ahead. This note is more geared to a broader picture and to those focused on daily and weekly time frames in their trading, possibly for IRAs and other long-dated accounts. So let's get into it. We've got a huge week ahead. Won't be any surprise to anybody that we've got the majority of FATMAAN earnings this week. We've got really everything but Netflix. We've got Tesla on Monday. We've got Apple, AMD, Microsoft, Alphabet on Tuesday. We've got Facebook on Wednesday. And then we've got Amazon on Thursday. And if you've been paying attention or been involved in markets for any length of time, you know that these are the biggest cap-weighted stocks in the market. I think they represent, and don't quote me exactly on these numbers, but like 40% of the Qs and north of 25% on SPY. So it boils down to this. I mean, as far as these earnings go, if they buy it, we're going higher. If they sell it, we're going lower. And that, I'm not trying to make that sound like it's profound. It's just math. I mean, we've had a tremendous run up in these names for the most part. I mean, we're talking Apple, Facebook, Microsoft, Google, and Amazon have all broken out. They're all running. They've had big run-ups. That's usually not a great setup into earnings because then it just makes it that much harder to come up with something so unbelievably awesome that they want to buy more. But stranger things have happened. So I don't think we can, front run, oh, they're going to sell it or, oh, they're going to buy it. I mean, that is in a nutshell why I tend to be defensive during earnings and not take a huge directional bet either way, because we've seen, good earnings get sold and disappointments get bought. Now, in these names, they're all going to beat. I'm sure they're going to have monster quarters. It just depends on, that sentiment for these names. Have they run up too much, or is there more gas left in the tank? So we're all going to be watching that really, really closely. And also, we've got a massive macro week ahead of us as well. So we've got a lot of stuff. We got Monday, not a whole lot. We've got some bond auctions. Short-dated bond auctions. We've got new home sales on Tuesday. But then we start getting into the meat of the week. We've got durable goods, which will be a good read on the real economy. We've got a consumer confidence number coming out. And then the Fed starts its meeting. And then we got a 5-year bond auction at 1 o'clock on Tuesday. And then Wednesday is a huge day. We've got Jay Powell, we got the written announcement at 2 p.m. and then we've got the Jay Powell presser at 2:30. Now, I am not the best Fed watcher in the whole wide world. I just know what I read in the papers, as they say. I think the COVID variant story gives Powell more cover on maintaining the asset purchases. That's my default position. Now, does he throw a curveball out there and say, inflation's running hotter than we really thought, and that has adjusted our thinking? Sure, all that stuff can happen, and if that does, you probably see a downwhoosh on a surprise hawkish statement. I don't think that's going to happen. I think at the earliest, it's going to be at Jackson Hole at the end of August. So I think this is a stay the course announcement, but with the potential for downside on a hawkish surprise. And then on Thursday, we've got GDP, which will be important, jobless claims, and then we've got a 7-year bond auction on Thursday afternoon at 1 p.m. And if you'll recall, a couple months ago, that was an auction that threw the bond market into a complete turmoil, where nobody came, nobody showed up to bid, and that drove rates crazy and caused some turmoil. So that'll be relatively important, especially coming after the FOMC announcement. If there's some kind of a ambiguity as to what Powell says, that may affect that bond auction, where all of a sudden people are reticent to pile into 7-year bonds if they think rates are going to be going higher. And then on Friday, we've got the employment cost index, which will be relatively important because that's what's going to reflect these wage increases and raw cost increases. We've got personal income, and then James Bullard is out at 9 o'clock before the market opens. He seems to have emerged as a point guy for the FOMC. If you recall, last month after the meeting, he was out there front and center talking, on media, CNBC and Bloomberg and all these outlets. So if you recall, the last time he spoke after a meeting, there was a pre-market sell-off. Now, I think that sell-off ultimately got bought, but there was a fairly significant rug pull, if I recall that day correctly, where he was, a little bit more hawkish than you would have thought, and so there was a sell-off. So Friday morning is going to be important. Then we've got Chicago PMI at 9:30, and then we got University of Michigan sentiment at 10 a.m. So taken together with all the earnings coming out, and there's a lot of other, we just focused on FANG, but if you look at that calendar for next week, it is loaded with big names. I think Visa was up there, Caterpillar, a lot of important marquee names. UPS was on there. So there's a ton of, we're in the thick of the season now. So watching those earnings reactions are going to be really, really important. And then combined with, I think Jay Powell always has the trump card on what he says. So it's going to be a monster week. Now, for this week's title of the video today is cognitive dissonance, and I think that's really what we have in the market. And out of the Merriam-Webster dictionary, cognitive dissonance is the state of having inconsistent thoughts, beliefs, or attitudes, especially related to behavioral decisions. Now, an example of that would be, boy, I really like to smoke, but I know it's probably going to cause me cancer, right? Holding those diametrically opposed thoughts in your head and then deciding what you're going to do about it, or how you're going to rationalize what you do about it in your own mind. And I think as far as the market, we have got some massive, massive cross currents out there. And I think it's causing, or has caused, people a lot of pain over the last couple of months. And let me go through some charts to kind of show you why, and show you why, kind of where we are at right now. And I will provide some commentary along with these charts to, share my thoughts and kind of how I'm trying to resolve the cognitive dissonance that is out there. First example, we're at all-time highs on SPY and QQQ, right? This is the NYA 50R. This measures the number of stocks above their 50-day moving average. You can see we're at 40. So while the indexes are at all-time highs, the average stock, 60%, are below their 50-day moving average. That is not bullish. That is not bullish. You can see, just in recent memory, we were up near 75%. And over the last 2 months, the average stock has had a massive rug pull. And if you're a guy or a trader or an investor that has any kind of, diversified holdings, I'm not going to say you were killed, but you're not making any money, that's for sure. And so you're sitting here watching SPY and QQQ go up every day, and your P&L going down every day. That's got to be massively, massively frustrating. So the breadth of the market is poor, and everybody has piled in to the mega cap names that are driving the top line indexes, SPY and QQQ. Example number 2, stocks are at all-time high, but the CNN Fear and Greed Index is 32. So while stocks are at all-time highs, you'd expect to be over here on the greed side. Most people are still bearish at 32. And you can see that just recently it was even lower, down to 23 and 25 down here. So my point here is, what if these people, what's the pain trade? Is the pain trade higher or is it lower? Well, if everybody's already bearish, can the market crater? Or do all these people have to be pushed over to pile in to get everybody on the boat bullish before they pull the rug? I'm not sure, but I think this being a contrarian indicator would lead you to believe that what these people are feeling is the fear of their own holdings, because they've seen their holdings go down over the last 2 months. And so that gets them fearful. So I don't know. I would tend to think that these people got to flip bullish before there's a massive opportunity for a rug pull. You don't often see a big rug pull with sentiment this bearish. So let's move on to the COVID variant fears versus reality. And if you, even if you don't watch financial news, you watch whatever your news outlet is, your Twitter feed, your stock twits, your nightly news, the Delta COVID variant is front and center. And basically, to sum it all up, it's racing through the country and the world, and it's a disaster, and it's going to derail our economic rebound. But let's look at the facts. And a lot of these charts are from Cam Huey and Callum Thomas, and I've clipped that. So kudos to them for putting some of these charts together that I've lifted. This is Apple mobility data, 7-day running average for the biggest cities in the country as a whole. Mobility data is on the rise. People are out and about. This has not rolled over. And you would have thought that if the COVID variant scare is racing through people's minds, that they would naturally draw inwards, right? I mean, that's what we're talking about, that the COVID variant is going to put the brakes on the economy. And as far as this Apple mobility data, shows everything on an upward trend and not rolling over. So that doesn't support a meltdown scenario. Let's look at TSA. TSA 7-day rolling average. We've got up here on the top, we've got 2019 data. The dark blue is 2020 data, and red is 2021 data, 7-day average. We're on a steep upward trajectory on airline travel. I mean, almost to the point of this 70% level, which was a level that in 2019, towards Q3 and Q4, we bounced between 70 and 80% capacity. And so we're almost there. And if you would have thought that COVID fears were slamming the brakes on airline travel, I mean, this has been front and center in the news for weeks and weeks. Airline travel has done nothing but go up. So another check mark for fading the COVID fear. Movie sales and attendance. Dashed line is a 3-year average of 2016 to 2019. The dark blue is 2020 flat line. Everybody's in lockdown. And here in red is 2021. You can see that people are getting out and about and going to movies. That to me is everyday life in America. People are getting out. You know, travel, you might be able to rationalize, well, people haven't seen their family in, 2 years. They haven't been on vacation in 2 years. They're going to bite the bullet. They're going to wear the mask and travel. Movies are a totally discretionary activity. It's just something you go do for fun with your family. And if you're terrified of that COVID variant, you're not going to go to the movies. You're going to be scared, but don't see that in the data. And so this is another example of real life information not jiving with COVID fears of a crashing economic recovery. And Cam Huey and Callum Thomas have a whole raft of other high frequency data, whether it's hotel occupancy, gasoline demand, restaurant reservations. Those are all trending higher, not lower. And so these high frequency economic indicators are saying the recovery is still on track. And so my message to you is fade the fear. There's nothing to indicate in the numbers that the economic recovery is rolling over. So now that doesn't, the real economy, you understand, doesn't have anything to do with stock prices. So we'll get into that. But it's good to know, or it's important to know what's going on in the real world And then that will eventually, I would think, roll into the stock market in the way of earnings that a lot of these guys are still yet to report. Let's look at bond yields. Bond yields have been cratering versus inflation ripping. They're totally diametrically opposed to one another. You would think that if inflation is ripping and the economy is ripping, that bond yields would follow. And that was the case back here from the November lows. We did have the rip into April where we topped out at 1.75% on a 10-year. And we've been on a slide. And now, over the last, let's just call it 2 months, we've gone from 165. We saw a low of 1.15, and now we've got a little bounce up to 1.3%. But this has been a dramatic rug pull, and that has whacked IWM. That has whacked all the cyclical names, and that's where we've seen large cap megatech rip, and we've saw the average stock get nailed pretty significantly on this rate decline, which the bond market is saying that there's a growth problem out there. And so there's a complete disconnect between the bond market and the real economy. And it's way beyond my pay grade to tell you why. Maybe it's Jay Powell influencing the whole curve and suppressing the rates. And as long as those bond purchases are in place, they're just not going to go anywhere. And so that's what we've got to watch going forward, that if rates break out of this trend line or this trend channel, break above 1.3%, break above 1.4%, and get on an upward trajectory, we'll see that, and then that'll filter in to getting back on the cyclical bandwagon. But for now, I don't see it. This will be an important week. Jay Powell, he's going to influence his curve. That 7-year bond auction is going to influence this curve. And so, we are here at the top of this little downward channel that has been in place. If we roll over here and head back down to the bottom of the channel, there's going to be more pain in cyclical stocks, and you'll see a even stronger bid come into tech. The ARC names, the mega cap tech names, the high valuation bubble stock names, Roku's and Docu and all the stuff like that will continue to see bids. Now, here is the TLT, and this trades opposite to bond rates. So if bond rates are rising, TLT is falling. You can see this was get on the cyclical bandwagon. Rates were rising. We had a long consolidation. Now rates have been falling, and I've got this trend line here off of the TLT lows or the rate highs up this way. Excuse me. up this way. Gosh. Sorry about that, guys. This is my pivot point for the cyclical trade. As long as TLT stays above this trend line, I'm going to avoid cyclicals and I'm going to favor tech. If we break below this trend line, lose the 200, lose the 50, that will tell me that rates are by definition going higher. And so a break of this trend line, and certainly a break of the 200 and then the 50, I think will be game on for cyclicals. That will be a sell signal on TLT, and you can play that directly if you care to, if you want to play rates directly. But it'll be a flag, a green light for cyclicals if this trend breaks. And if rates start heading back down again, this could very well it will. It'll break through 150. It'll break through this high, and it'll be reaching towards 155 on TLT. So watch TLT for a read on cyclicals and a read on rates. Cognitive dissonance example number 5. Commodity prices are surging, but commodity-related equity prices are dogging. And so if we look at the Commodity Research Bureau aggregate commodity index on the monthly chart, you can see that recently we broke out of a 10-year downtrend. The peak was back in 2008. Commodities have been in a downward slide basically ever since, and now we just broke out. So we're a stone's throw away of taking out this 2015 level, and we break above 230, we could easily see 270 on the commodity price index. You can see here the US dollar is in a trading range and has been for years. If we break below 90, I think it's actually 89. If you go to a dollar index chart and look at that, falling dollar is bullish commodities in general, because they're all settled in dollars. So if you have a weaker dollar, you need more dollars to, settle your commodity contract price. And if you notice here, at the spike COVID low, dollar was at the high of the range, and now it's at the low of the range. So during this time when the dollar was fading, commodities were ripping. Now, if the dollar were to roll over right here and break support, that would be a big signal for game on resources. Now, I think it's important for you guys to note that oil is half of this index. Cotton can do what it wants, and, everybody is now a lumber trader. It went to 2,000, now it's 600. So, commodities are coming down, right? Wrong. They're going up. Lumber is the exception, not the rule. And you can see right here on WTI, we are threatening a very important resistance level right here, about 77.50, right in that area. You get a breakout there. You get a breakout above this 2018 level, and we've already tagged it once, and now we're right back up there again. You get a breakout there, at least according to this chart, 100, 110 would be in the crosshairs. And to my way of thinking, there are a lot of forces at work that would love to see oil north of $100. You've got a whole contingent of people that want carbon-based forms of energy expensive to drive the green transformation. You've got an administration that's putting in policies that support that, making it difficult to get drilling leases, taking wide swaths of government land and putting them off limits, generally making it difficult for drillers to get those, secure those leases. Plus, you've got the whole ESG movement that has starved or discourages investment in carbon-based energy companies. And along with that, during this whole period of 2015 to 2020 and even 2021, these companies have been starved of capital because private equity and a lot of companies invested in these drillers, back in the coming out of the financial crisis, and they got burned very badly. And so there's been a reluctance to fund these companies. So as far as domestic drillers are concerned, they've had to become much more judicious in how they approach drilling. And I think 5 years ago, when the price goes up $5, they all pile into new wells and start drilling, and you see that supply response, and you just haven't seen it this time. I mean, look at Halliburton, look at Schlumberger. They're nowhere near where they used to be. I'm not saying they can't go higher, but if you see oil go from $20 to $80, you'd think they would be doing a moonshot, and they're just not. And that's a sign that their services are not in as high demand as they used to be, because the domestic and actually worldwide producers are not going after new discoveries and production like they used to. So watch oil, watch commodities. That'll filter into inflation. You'll start hearing, when we take out 325 and 350 and God forbid $4 on gas, you're going to hear the outcries. And but by then it's too late. I mean, everything is the horse has already left the barn, because you can't just turn a knob and take gas from $4 back to $3. That's a direct supply function. And as the world reopens, you're going to see a huge spike in demand. If India ever gets back online, and Europe and the States, you're going to see a massive spike in demand for carbon-based energy. Here's just an example of what I was talking about, that energy equities have not kept up with the price of oil. XOP is an ETF that tracks smaller E&P drillers, basically taking out Exxon and Chevron is what this is. And you can see that when this ratio is falling, that means the price of oil is going up faster than the price of the equities. And you can see we just lost support here. And it's been going sideways. And if you look at the charts, you'll see that, yes, XOP has gone up since the beginning of the year, but the price of oil has gone up faster than the equities. So that's a signal that if you really want to play oil, you've got to play the commodity, at least at this juncture. There may be a point where equities catch on fire and it's a big catch-up trade. We got to be ready for that. But USO, you can go to the USO tracks the oil futures. You can play oil via USO, or you can go into the futures market if you're comfortable with that. All I'm saying here is another example of cognitive dissonance, where you would have thought that oil equities would be running with the price of oil, and we just haven't seen that. Let's take copper as another example. Back here, everybody was a copper bull. Now for 2 months, you haven't heard anything about copper, but guess what? It's about to break out. In fact, it already has broken out. We've had this symmetrical triangle here. Price has broken out of the downtrend. It's recaptured all its moving averages, and now it's here at this resistance level at spot 45. You get a breakout there, and then copper is back to the races. And I've put some copper plays down here, and you'll notice, Freeport and Southern Copper, they've been dead in the weeds. You've got a copper miner ETF here, and then CPER is an ETF that tracks the price of copper. If you pull that ETF up, you'll see that it mirrors this pretty well. So that might be a good place to look to play a copper breakout here above 445, and then watch Freeport and Southern Copper to see if their equities react positively. And then last one on commodities, steel. Consolidation. You've got price inching above all the moving averages, and that's a nice place that I like on the charts. Why? Because once price takes out all those moving averages, then those moving averages become support, and you get a breakout here above 62 on the steel ETF. That's going to be a time to sit up and pay attention to these steel stocks. Now, BHP, Rio, and Vale are all iron ore plays. They tend to go with steel prices, but then your direct plays on steel are Cleveland Cliffs and U.S. Steel and Nucor and these other names here that you may want to, if you want to drill down and look at individual names, look for breakouts there if the names follow. And so we're right at that level here. I think you should put an alarm at 62. Now, this is a good example of how I like to use ETFs. If you look at the SLX steel ETF, obviously it's a tracking index for the steel names, but there's no volume there. The option chain is not that liquid. So the way I like to use these ETFs is simply for tracking. Instead of trying to go and set 10 alarms, I'll set an alarm on SLX at 62. I might have a favorite name or two in this list that I'll set alarms there, but these names are not going to go anywhere until the aggregate breaks out. Birds of a feather flock together. When steel breaks out, these should move. Until it does, they won't. So that's how I use ETFs in that regard. So as I said, there's a lot of pain and frustration out there, and I think a lot of people have been trapped in these sector rotations. Just about the time we saw that Monday when bond yields spiked on the sell-off in equities. You saw IWM and a lot of these cyclical names rip 4 and 5 and 6%, cruise lines and all this stuff. And on Tuesday, they took it all back. And so that's why I want to be very, I don't want to jump the gun. I don't want to front run this supposed cyclical move. I want to wait till I'm sure, or as sure as I can be, before piling into that name. Because let's be honest, tech has been so good to us over the last 6 or 8 weeks. It's not even funny. I want to stick with that trade. We're in a falling rate environment for whatever reason, and that's bullish tech. So I want to stay with tech, and it hasn't given us any reason to abandon that trade. So I want to stick with it, and that goes into my key market thoughts. Falling rates are still in control. I'm going to use that TLT uptrend line as a pivot. It's not only a pivot on rates, but it's a pivot on, do I want to be in tech or do I want to be in cyclicals predominantly? And right now the environment favors FATMAAN and technologies we just talked about. All that said, we've got a ton of risk this week. I mean, between Jay Powell and all the FATMAAN names reporting, it's a setup for either a moonshot or a giant red bar. And for that reason, it's risky to go out there in a big way trying to guess. And that's all you're doing. You're guessing. You're guessing what's going to happen with Powell. You're guessing what's going to happen with these FATMAAN earnings reactions. And so what I'm going to do is I'm going to take risk down. I've been heavy in tech as far as it goes, and the FATMAAN names. I've been in the Qs and individual FATMAAN names. It's worked out great, but I don't want to see my gains over the last week or two erased because I tried to get cute on earnings. Now, I'm not going to get into what kind of strategies you might want to do, to try and play longs. I'm going to do a FATMAAN focused video before these earnings come out to take a close look at all of these charts. It's a little beyond the scope of what I want to do today, but they've all run a lot. They can go farther than we can expect, or they can pull the rug, or they can buy them on Tuesday night and then Jay Powell pull the rug on Wednesday afternoon. You just have no idea. And for that reason, I'm going to be rather defensive this week. I think after this week clears, we will know. And I'm always of the view there's plenty of time to get long, or there's plenty of time to get short once we know what's what after this week. And I truly do think it's going to take the balance of this week to play out before we get some clarity on, okay, what was the knee jerk? What's real? What's the new trend, if at all? Is it the same trend that we've had, or is it, or has something changed? And also, there was a thought that I had. I was listening to a podcast recently. We know there's been turmoil in China. Baba, JD, God, what are all the names? All the China diploma mills. You think you're in a for-profit business until you get a knock on the door and you're told you're not anymore, and your stock goes to zero. And they've been leaning on these companies, and there's the thought out there. Say you're a hedge fund manager and you got a significant amount of money in Baba and Baidu and JD and all these names, and then you have an earnings announcement, or your quarterly results have to be posted, and something happens with Baba and if China leans on these names harder, and there's another giant red bar. Do you want to explain to everybody why you stayed long when it was obvious that China was leaning on these names? It might be a hard conversation to have. So what if all these hedge funds just say, you know what? I'm getting out of these names. I'm getting out of Baba. I'm getting out of these big names. I'm going to stand to the side, wait for the dust to clear. And if Baba stabilizes and China stabilizes, I'm back in. But until then, where am I going to put the money? Where am I going to put the money? I'm going to put the money in FATMAAN. I'm going to put money in Facebook and Microsoft and Amazon and Google and, all those names, because what we saw last week in FATMAAN was not normal. You know that, right? It was not normal. And where is all that money coming from? Did Facebook go up $30 because Snap had a good earnings? You know, I can see a bump, but I don't see $30. Where's the money coming from and why? So there may be forces behind the scenes that are driving this action to the levels that we've seen. So have to keep an eye on that. What to look for in a regime shift. I want to be ready for that cyclical move if and when it comes. It could, come next week. It could not come at all, but I want to be ready. I did a spider sector review video that's posted on the channel. If you go through that video, all these cyclical ETFs are on the verge. They're right there. They're below resistance, but they're close. Materials, energy, finance, financials, industrials, banking, IWM. I want you to go watch that video, and I want you to set your alarms on those ETFs simply as flags. And if you get the breakout, my money is on all those things firing within a day of each other. If they go cyclicals, they're all going to fire. And if they don't, I don't think any of them are. And then you can look at, you go through materials, you got your commodity and specialty chemicals, you got metals and mining, you've got industrials like Honeywell and 3M and GE, your infrastructure names. Airlines will pop if they go cyclicals, your UPS and FedEx. All your marine transport names will go. Regional banks are highly levered to the interest rate, so you get a rising interest rate environment. That's gonna pop regional banks. You've got travel stocks, Marriott, Hilton, cruise lines, all the reopening names. They're all gonna go if there's a snap rotation into cyclicals. So if you've got favorite names, you can go in and set yourself some alarms at where you want to get a heads up on a breakout. But the shortcut way is to set alarms on these 5 or 6 ETFs. And if you get a breakout in financials, then if you're a guy that wants to drill down and say, I want to get an individual bank name or an individual, industrial name or Freeport name, whatever you want to do, you can do that. But you got to get the breakout, and I would not front run it because the guys that have been front running it have been getting killed. They've all been head fakes. So let's wait for the real signal. Let's look at SPY. We caught this perfect. The world was ending Monday. We said buy it here because we were extended to the downside. NYMO was minus 90. That's not a place to be short. It's a place to get long. And then we got the rip of all rips. Looking at the structure or the posture of the market, price is above the 8 and 20-day moving averages. Those were recaptured, and we took out the all-time high. So all-time highs, you got to buy. There are no natural sellers up here. And so now what we can do going forward is we can stay long against the prior high up here at 437.50. There is a little baby gap below. I would not worry about that. I think it's less than $1 wide. So there isn't, a big crisis. But looking at the channel, we've recaptured the moving averages. We took out the all-time high. We recaptured the bottom of the prior uptrend channel. I mean, we could go to 450. It's open. The move to 450 is open right now to the midpoint of the channel. So don't discount that might happen. And we've got a very tight stop here at 437.50 in that area, the prior high, that, you know what, we roll over and we come back down in here. We can get tactically defensive and wait and see what happens. So I think we can be confidently long, knowing the posture of the market. Now here's a big yellow flag that I want to throw out here. We've still got bearish divergence, and that's a yellow flag. So we've got a divergent high here. Why? Because for a number of reasons. We peaked in momentum way back here, and now price is dramatically higher, but yet momentum is lower. And you can see even here, we had a momentum at this all-time high. Momentum was here, and now we've taken out that high, but momentum is lower. So that's a divergence and a warning sign on momentum and a warning sign on RSI. So you can't just fall asleep here and say, be long and close your eyes. Keep your eyes wide open, keep your head on a swivel, because what could happen, and we've already talked about it, we could have a green Monday and a green Tuesday going into Apple and all those names, and then they sell them after hours, and you get a giant red bar that comes down here if they just wholesale liquidate those large cap names. You could easily lose this trend line and support and then the whole thing, and then we got to really stay on our toes. So that's why I want to be I don't have a problem being long, but I'm not putting everything on it. I want to participate on the upside, and I'll be willing to take a paper cut on the downside, but I am not going out there full force this week betting on a long. And that would be my recommendation to you as well. Here's the Qs. We really didn't even get a pullback on that Monday flush. I mean, it went down a little, but you can see the posture is great. We've got a long-standing rising channel on the daily chart. We are above all the moving averages, 8, 20, 50, all with positive slopes, all bullishly stacked. We took out the prior high. We're at the midpoint of the channel. And so now we break out here, we would have a path up towards 370 at the top of the channel. And the same comments apply on momentum here on the Qs as well. We had a momentum high, but now we're at all-time highs with lower momentum. That's always a yellow flag. But the thing I like here is that momentum has not given us it's not flattening. Normally what you would see is a flattening of the peak where you start to roll over, and we haven't seen that yet. And actually here on RSI, we've broken out above this trend line. So it remains strong, with the caveat that earnings can change everything. It's set up for either a moonshot or a rug pull, and I have no idea which way that's going to go. And finally, let's wrap up with IWM. Loaded with cyclicals, an aggregate of 2,000 stocks. We were up here at the highs looking for a breakout, cyclicals. And then they pulled the rug on rates, and we went all the way down to the bottom of the box where, here was your location for an objective long. We came up. If you look at the videos from midweek, we said, you know what? If you're a swing trader and you didn't buy here, you got to wait. You got to wait to take out this midpoint, to take out the 50 EMA at, where are we at? 223.50. I've actually got the midpoint here at 222.50. You take that out, I think you can see a run to 232.5 up at the top of the box. But if they roll rates over, then you could easily see this come back down for a back test of the bottom of the box down at 212. And then if you get a break at 212, the world will be ending, and that would be your place to get short and look for a measured move down into 190. That's not my base case, but you got to follow price. And if price were to take out this 6-month consolidation range, you don't have to get short, but I sure wouldn't want to be long. So that's going to be an important spot. Your important spots are 212 to the downside and 222.50 on the upside. If we get a breakout here, you're probably going to see or hear all your alarms go off on your cyclical sectors and a lot of your specific names that you hopefully will have had alarmed, because then I think we're going to have some rising rates, and that would be bullish for cyclicals and maybe a headwind for your ARCs and your bubble names and all that kind of stuff. So anyways, that's what I see for the week ahead. Biggest week we've had in a long time, due to the confluence of the FATMAAN earnings and the confluence with the Fed announcement. And I think my recommendation to you is don't you never want to bet your life on any one particular trade or one particular week. If you want to take a shot on the long side of FATMAAN or the market in general, feel free to do that. Just know or assume that they may pull the rug and wipe out that position like in 5 seconds, depending on if that's what happens. And I will say this as well. Let's say you wanted to be long and you said, okay, I'm bullish FATMAAN, but I have no idea which one might go down or which one might go up or what Jay Powell might do. And so I'm going to play with the Qs, right? Which is going to be an aggregate of all those names. There's going to be a lot of implied volatility built into the Qs next week, not only because of all these earnings, but because of the Fed announcement. What if you were to go out another week or a week or two from now? So instead of the end of July, you look at the beginning of August or the midpoint in August and say, you know what? If there's a wobble, from the Fed or a wobble from FATMAAN, I will my long calls 2 to 3 weeks out will take a hit, but they won't be wiped out. They won't be wiped out, and I won't experience a massive drop in implied volatility, because if you get something for Friday next week in the Qs and there's a decent sized red bar, I can almost assure you you're going to take a 0. Whereas if you go out 2 weeks, you're going to take a hit, but you will also have time for them to buy it up as well. So I would play I would play it that way. I think that's the way I'm going to play it. I am long right now, the Qs, but I'm going to see how Monday and Tuesday go heading into those. I'm not really worried about Tesla Monday night. Tesla is like its own thing. I don't think it's really tied in like Facebook and Apple and all those names that are going to report Tuesday night. So I'm going to be bullish the Qs and FATMAAN heading into Tuesday night. I'm long AMD as well. I'm going to be bullish those names heading into Tuesday night, but then I'm going to be out before earnings, or out if I see they start selling into earnings. I'm just going to get out and reposition out at least a week or two on the bullish side. And then if everything resolves bullish, I'll make some money. Not a lot of money because I'm not going big on that type position. And if they pull the rug, I'll either take a paper cut and close it out, or sit tight, see if it's just a knee-jerk reaction, give people time to buy it up, and then maybe in 2 to 3 weeks, we'll be back on track. So I hope the analysis helped. If you're new to the channel, please hit the subscribe button. Longtime viewers, hit the like button. I'd really appreciate that. It's helping, I think, in my Google or my YouTube searches to have those likes. I really appreciate all the new viewers coming online and being a part of our community. Look over in the show notes and you can actually there's a link to drop in your email and join the group officially. It's free. It takes 5 seconds, and then you'll get all my information over the weekend, during market hours. Whenever I have a thought, I send it out to the group, trade ideas, etc. We'd love to have you. And I'll also send you a link to our trading room that has been growing nicely lately. A lot of good ideas, a lot of generous traders, a lot of good traders in there, both guys and gals. So we'd love to have you there if you're interested at all. And longtime viewers, I really appreciate the support. And do me a solid by reposting the link in your trading circles, in your social media, and help me expand the channel. So this has been Chris Buss with Traders Profit Compass. Hope you enjoyed the video. Enjoy the rest of your weekend. We'll hit it hard tomorrow morning, and talk to you next time.